Welcome to our viewers on PBS in America and around the globe. We start in the US, where regulators have shut down Silicon Valley Bank, a major lender to tech companies after it ran into financial trouble. Worries about the bank triggered a sell-off on global financial markets. It's the largest banking failure in the US since 2008. Our North America tech correspondent, James Clayton, has been explaining how it happened.
Well, this is one of those days that will go down in Silicon Valley history, and it's certainly one of the most stressful days for Silicon Valley founders in modern times. We've spoken to people today who have been able to withdraw their money from Silicon Valley Bank and some who haven't. One person I spoke to earlier said they put a wire request yesterday. They waited nearly 24 hours and eventually found out they had got the money out. But we spoke to another person who says they have tried and tried and tried, and they simply haven't been able to withdraw any funds. They said they actually physically came down to one of these branches to try and get the money out. It's been an incredibly stressful time if you're a startup. Now, the Federal Deposit Insurance Corporation has essentially taken over this bank, and they are literally in there now advising customers what to do. And the hope is that they will be able to withdraw their funds on Monday. But that is no certainty around that claim at all. And when you speak to people who haven't been able to get their money out, it is a time of deep, deep concern. They may well not know for another 48 hours whether that money has completely evaporated. And there's another worry too, that this isn't just a local story about startups, that this could spread to other banks across the world.
James Clayton reporting there. We can speak now to Danny Blanchflower, who's a Dartmouth College economics professor and former member of the Bank of England's Monetary Policy Committee. Thanks for joining us, Professor Blanchflower. So, with regards to what's happened here with Silicon Valley Bank, why has this happened? And clearly it's at a time where we've just had a big era of low interest rates, and now they're starting to creep up.
Well, I think it's a combination of things. The first thing is that the Fed started to raise rates and raised them rapidly, thinking there wasn't going to be any fallout, and that was almost inevitable. The place that it really hit hardest was in the tech sector, and it wouldn't take a genius to work out that if the tech sector's in trouble and the central bank is raising rates, banks that lend to tech companies are likely to be in trouble. And that's really where we are, not least because these banks that we look at, it's one bank, it's the Silicon Valley Bank, there are a few others that we worry about, that they really haven't diversified their portfolios. They put their money into, think of crypto and into startups in the high-tech sector. So they're vulnerable. But listeners should think that, I was listening just then, it reminded me almost exactly of what happened at Northern Rock. On the Monday, the bank started to lose money, and essentially the website crashed on Wednesday, and the Chancellor of the Exchequer had to work out he's got to do something over the weekend because banks are going to have to open, markets are going to open on Monday. And I think that's the really big deal. What is the Fed going to do over the weekend? Remembering the story you just had was that, yes, there's FDIC, Federal Insurance of Deposits, only up to 250,000. Over that, we don't know what's going to happen. They may get their money back, they may not. But the danger is this sets a domino going, and there's panic around the world. Hopefully that won't happen.
But is there a genuine concern about that? Because as you say, in terms of diversification, and that's when a bank perhaps has investments and assets in lots of different parts, that has changed quite considerably since the financial crisis in 2008. Are we looking at a similar scenario, do you think?
Well, we are. I mean, in some sense. I mean, what we've seen is banks, the big banks especially, have been made very liquid. They've been told to diversify their portfolios. But these somewhat smaller banks, under 250 billion in assets, quite a lot of money, but they were much less regulated. And under Trump, regulations were reduced. And in fact, one of the people pushing hard for it was the CEO of this bank. So these are not so subject to regulations. I mean, the reality is that the central bank and the Treasury, Janet Yellen and Jay Powell, have got to, over this weekend, make sure that panic doesn't break out things are done over the weekend. So they are hopefully working feverishly. Remember what happened in the UK to Northern Rock.
Yes.
There was no deposit insurance at all. And on Monday morning, Alistair Darling announced that all deposits within Northern Rock were guaranteed. And the difference at Northern Rock was that actually people stood up outside the banks, lined up to try and get their money out. So the worry here is, hopefully it won't happen. I certainly don't want to spread panic. But what we learned in 2008 was banks in Florida were connected to banks in London and in Germany and in Japan and everywhere else in the world. So the worry is that this is a domino that will develop. We need to absolutely make sure that...
And just briefly, Professor Blanchflower, will this impact the trajectory now of interest rates? Because, as you say, the governor of the central bank in the United States, Jay Powell, is going to have to discuss this situation this weekend. The thinking was that rates would continue to rise.
Well, markets are already pricing in rate cuts later in the year. It looks certainly that most of the things that the Fed has been saying really unlikely to be true. We saw unemployment today rising by 0.2, which is worrying. So I think the answer is markets are not really going to expect to see the Fed basically raising rates. Inflation is already coming down, and the danger is that there was always a danger when the Fed kept saying, oh, all's fine, don't worry, we can raise rates, all will be just fine, all the architecture we put in place is just fine. And now this is the first step suggesting that isn't true. They can't afford a second one, but there were 3 or 4 other banks over the last few days, and banks around the world have been impacted. So the worry is that this is, think of dominoes, one falls and the danger is the rest go. And I don't want that to be true. But we need to be watching that story, and Monday is going to be crucial.
OK, we'll be watching that closely. Thank you very much, Professor Danny Blanchflower there, joining us.